Hey everybody, I'm back with Jeff McCarthy, one of our awesome loan advisors today, and we're going to be talking about how to get into a property and have your neighbors actually pay your mortgage. Sounds crazy, right? But let's talk a little bit about it. Jeff?
Yes, I agree. It is a little bit of crazy, and let's preface this with you're not just going to buy a house and they're going to pay all your mortgage, but that would be nice. And eventually that is the goal, right? And that is the goal. But right now it would be, how do we kind of maximize the higher interest rates, and how do we figure out everything that needs to go on to kind of help you hedge this market right now. So we can just dive in and we'll just kind of give you some pros and cons on what we're seeing here and how we can help you maximize your profits and actually get into a larger home. And we'll kind of run through some numbers after we kind of go through the pros and cons of this. But whoops, go back. So we can dive right in here and check everything out. So we're going to go through FHA first because I really feel like FHA right now is a very strong loan. A lot of people back, 21 and 20, they were, cash or conventional. But with a lot of the new loan level price adjustments, which I'm sure a lot of everybody has been hearing, and we talked about it a little bit, conventional's gotten a little expensive. And FHA is a great alternative, and they have much lower rates. So we can kind of we'll go into FHA first, and then we'll go into conventional second. So the best thing about—
And just to clarify for everybody real quick, we're talking about multifamily because
yes,
we didn't put that out there. We're talking about multifamily units.
Yes, multifamily units. So that's how we can help your neighbors pay your mortgage, essentially, is not buying a single family residence and knocking on your neighbor's door, but really going and buying a 2-unit or 3 or 4 unit and having your renters, which could be your friends or, people that you, lease the unit to, help you subsidize that mortgage payment. So for FHA, you can buy up to a 4-unit property. We'll go through the details there. And the best part about that is you only have to put 3.5% down on that property.
That's awesome.
So that's great. You don't have to use a lot of money out of pocket, and you can buy a pretty good property for only 3.5% down. So really good pro right there. Another one is you don't have to be a first-time home buyer to use FHA. Not many people know that, so
right.
You could have just sold your home and then easily have gone to use an FHA and buy a 2-unit and still be able to only put 3.5% down. So that is a great—
And there are certain circumstances where you can have 2 FHA loans at one time, right?
There are,
weird, but
yes. And that is something where it would be a case-by-case scenario. So if you do have an FHA loan right now and you wanted to retain the home, it is a little difficult to buy a 2 or 3 unit with FHA. It is doable. It would have to take some explanation and a little bit of guidance from the underwriter to help push that through, but it is obtainable. So yes.
Okay.
So you don't have to be a first-time home buyer. The max loan amount for a 4-unit is almost at $1 million, which is great for FHA. Exactly. And that, just to let you know, that is a 4-unit. So if you go to 3-unit, there's a different max loan amount. I believe it's in the $800,000, and then you keep going down until you reach a 2-unit. But it is not capped off at the single family, which is in the $400,000. So you get a little more buying power.
Right.
And then this is good too, the low reserves requirement. So when you're buying a 2-unit, the lender, what reserves are is the lender wants to make sure that in case of emergency, you have a little bit of money to help pay the mortgage and whatever you need to, the taxes and insurance for that month. So when you're buying a 2-unit property, you only need 1 month of reserves, and that's the full payment: principal, interest, taxes, insurance, and HOAs if you have that. And
is that going to be just in your account, or is that going to be like something that you put towards escrow?
That is something that just needs to be verified in your bank account. So
okay.
You don't need to put that in a title. You don't need to put that in an escrow account. The lender just wants to make sure you have 1 month for a 2-unit or up to 3 for 3 or 4 units to 3 months of full payments in your bank account. And this is the best part about this. And we'll show the big difference between FHA and conventional, but FHA always has lower rates than conventional. The reason is it's a government-backed loan, so and it's insured. So the lender sees that as less risk, Whenever lenders have less risk, they give you better interest rates. So you always get a lower FHA rate. So that is great. So those are some pros for buying a multifamily with FHA. We'll just take a quick look at a couple of cons right now. The higher MI. So we actually just did a video a couple weeks ago on the MI for FHA. So back like 4 months ago or 3 months ago, the mortgage insurance for FHA was about 0.85%. Now it's dropped down to 0.55%. If you put 10% down, it's 0.5%. So it's still a little higher than conventional, but it has lowered, which is great. Just a side note though, even if you do put 20% down on an FHA loan, you still have mortgage insurance on there. So that's what happens. It's just to help insure the lender against the loan, and then you get a little bit lower interest rate. It kind of helps offset the higher MI.
Gotcha.
Now, this is one that can kill deals. It's a self-sufficiency test. And so what that is it only applies to 3 and 4 units. And essentially what FHA wants to see is if you buy let's say a quadplex, they want to make sure that the rental income is covering the entire mortgage payment. And that can kill deals right now. Higher interest rates make higher mortgage payments. Sometimes rent doesn't equal the mortgage payment. So that's one thing that we got to think about when we wanted to buy a triplex or a fourplex, is we want to make sure prior to kind of getting into it that the rental income definitely supports the mortgage payment.
So a lot of times when I'm running an analysis on investment properties for people, I'm looking at your debt coverage ratio, your debt service coverage ratio. So is there a certain number that they require for this? I know a lot of lenders like to see like 1.25. I didn't know if there was like a set number for FHA.
And basically that is what it is. The self-sufficiency test is a DSCR number, right? It's a debt service coverage ratio. It just makes it say my debt is covered by my income. And so no, as long as it's 1-to-1, which means that for every dollar I have coming in, I have $1, or basically whatever dollar of debt I have a $1 coming in to pay that debt. So it covers that. And it just needs to be 1-to-1 on that.
That's not too bad then. Do they take into consideration being a primary resident in one of the units?
Yes. Yep. So all 4 of them got to cover the rent. So if you buy a fourplex. Yep.
Okay. So if it's something that somebody's considering doing, just make sure that your realtor runs those numbers and everything prior to, going under contract. It makes life a lot easier.
Exactly. And even before that, if we're at the pre-approval stage, we can easily kind of look at comparables, rental in the area, and kind of have a really good kind of bird's eye view on, will this work, or should we just focus on a 2-unit?
Right.
And now for conventional. Awesome. Yeah, it's not bad. FHA is very, very strong loan. I want to make sure everyone who's watching this, and especially the sellers and the listing agents out there, FHA is a super strong loan. Everyone thinks it's for the people that can't make it, and really what it is a lot of FHA is utilized for people that have a lot of student loans. And they can take that higher DTI, the debt to income ratio is a little bit higher just because of their student loans. So it's not necessarily a function of lower FICO or lower income. It might just have to be a lot of other debt that might be causing the DTI to get a little bit higher. But super strong loan, and now with lower rates and lower mortgage insurance, even stronger. So we'll go into the conventional side here. If you wanted to buy a 2 to a 3 or 4 unit on a conventional, so the same reserve, so the 1 month and the 2 month is exactly what we have for conventional. So that's awesome. You don't need, on an investment property, Nikki, I'm sure you're aware, sometimes you might need 6 months reserves if you're buying it as an investment property.
Right.
So here, only 1 month for a 2 unit and then 3 months for a 3 or 4 unit. Awesome. Really good. Helps the wallet a little bit. Maximum loan amount is a little bit higher, 1.369 for a 4 unit. So you have a little bit more purchasing power on the conventional side. reduced mortgage insurance. Now, on the next couple slides, you'll see how that kind of affects the cash flow when you sell the property, or really how it affects the mortgage payments. So it is considerable, and I'll give you 0.55, like I just said, for FHA. And conventional, if you have above a 700 FICO, you might only pay like 0.12 or 0.15. So a little bit lower helps you, helps you reduce the mortgage payment a little bit. No self-sufficiency test. That's a big one for conventional. So they don't really care. As long as you have, the income coming in and your debt to income ratio is fine, they don't really need to see the units providing that it covers the mortgage payment. So that really helps. And that could be something where if you're at an FHA and it doesn't pass self-sufficiency, we can always see if it makes sense for a conventional. But usually the first con we're going to bring up tends to be the big stopping one. And that is the down payment. Even if you're a first-time home buyer, you still have to put 15 or 20% down. And that kind of hinders people a lot.
It kind of almost defeats the purpose, as far as the trying to get into either an investment property at an affordable price, or trying to just limit your cash out of pocket.
Yeah, exactly.
It's the better route.
it doesn't make that much sense. I don't understand the whole reason behind it, because if you're occupying it as a primary resident, you should be able to take advantage of a first-time home buyer program.
The 3 or 5% conventional program.
Exactly.
I think but I don't make the rules.
But that's why FHA is such a strong product, because at 3.5%, you get in and you can really create some great asset, by just buying a 2 unit or 3 unit with only 3.5% down. And then the higher rates, and we'll see this in the next in the 2 examples we have coming up here. You don't really get the single family. If I was buying a single family residence and I was utilizing it as my owner occupied or my primary residence, I get a lower interest rate. If I'm going to occupy a 2 or 3 or 4 unit, on the conventional side, the rates get higher as the units get higher, unfortunately. So those 2 cons tend to be pretty big ones, I feel like.
No, definitely.
So we'll get in next. We'll see just some real numbers. I'm a finance guy. It's great to see the pros and cons, but let's see what the numbers look like, because that's what really affects everybody. So we'll look here, and we're going to look at FHA first. And for this, I definitely have to put my glasses on here. Getting older, it's not ideal, but it works. Now I can see. So we'll go through these 4 little scenarios here, and this is basically buying a single family residence versus buying a duplex using FHA. So the first column is I'm going to buy a home, and I'm going to buy just a single family residence. I can afford a $350,000 loan amount. And the interest rates are sitting right at 6.375 right now for FHA. That gives me an all-in payment of $2,748. So that's what you would be paying per month for a $350,000 purchase price right there. Let's figure you're young, you wanna maximize your properties. Even if you're older, like myself or a Gen Xer and stuff, this is still a great way to really start building a small mini real estate empire. The second column is let's buy a 2 unit under FHA, and the first thing you can see is my purchasing price is from $350, it went to $550. So $200,000 more, and we're buying a pretty big property right there. You're gone from $350 to well over a $500,000 property. Interest rate's the same. That's the greatest thing about FHA, 6.375. With the rental income coming in, and that's just 1 unit coming in because we're buying a 2 unit, your mortgage payment for $550,000 home is almost $300 less at $2,255. So that is awesome. You have really given the potential of buying a home and then lowering your mortgage payment right off the get-go. Really nice. So right now, rates are high. We're all feeling it. Some of us are sitting on the sidelines trying to figure out if we're ready to buy. Should I buy? Rates are higher. So let's just say you pull the trigger now, and then in 6 months or a year and rates drop down, you have that 2-unit property. Let's just do a refi. You're just doing a simple rate and term, and you're dropping your interest rate from 6.375 to 5.125. That's 5 1/8 right there. And now your mortgage payment for a $550,000 home went from $2,255 down to $1,832. That's less than rent in most areas right there. So now you have
our
a
average rent is well over that.
Yeah, exactly. What is the going rental for maybe for a property or something like that, a single family?
The average rent in Tampa Bay area right now is about $2,500.
Perfect. So even buying that 2-unit at today's interest rate, you are paying less than the average going rental, and you've now just had a $500,000 property that you're building equity on right there. So, and then after you refinance, your payment drops down to $1,832. So that is amazing. That's the power right there. And I will let you know that all of these payments, I already hedged and calculated the increase on the reassessment for the taxes. So
okay, awesome.
when you see these payments, you're not going to say all of a sudden the county's going to say, hey, we got to increase your payment. I already calculated the increase in taxes. So this is just something where you're looking at the as-is payment right there.
Love that.
Now this is my favorite part. So the last one is, all right, I've lived in it a couple years. It's time to get my own place. I'm going to retain this property. You can retain it, use an FHA. You could refi it when you wanted to refi and refi into a conventional. There's a lot of different things you can do, but I'm just going to say even at FHA, you keep it, you leave it, you're going to rent that other unit out. And now at that same interest rate of 5.125, you now have covered your entire mortgage payment, and you're now making $567 a month in profit from that 2-unit. Perfect. 2 years.
Great.
That's right. And then the other nice thing is, since you've lived in it for 2 years, we can utilize a lot of that as far as income from the property. We can utilize that to offset that mortgage payment for your new property. So your debt to income ratio is now only being hit by the property you want to buy, not by both properties.
I love this. I love telling people about this idea. A lot of people talk about house hacking, staying in a single family and then renting it out. But this just takes it to a whole nother level and helps you build that portfolio and build that wealth so much faster.
Exactly. Because this is not showing the equity you've gained in that 2 years either. know? So that is the best part about it. I mean, you could even take the equity out of your duplex to use it for your down payment on your new property. So many different things we can do. That's why I love it. It gets me excited because it just really catapults you into, real estate, being a real estate, little titan, if you will, and really, gaining some equity and really helping your family and your future. So that's with FHA, buying an SFR versus a duplex using FHA. So we're going to take a look at conventional right now. And we're going to look at a duplex as well, kind of keep apples to apples payment here. So $350 is the loan amount. $350 is the purchase price. 6.7. So you notice that the interest rate on conventional is a little bit higher than the FHA, but the payment is lower, and that has everything to do with mortgage insurance. So with the reduction in mortgage insurance, your payment on an SFR, single family residence, with conventional is only $24.54. The other thing I do want to say about this, and I'm glad I put a note up here on that, is this is with 15% down. So that's why the mortgage payment's a little bit different, because I wanted to keep it equal, because on a duplex, you'd have to put 15% down anyway. Right. So I just wanted to make sure that everyone knows that all of these is with all 15% down. So we can look at the second column. We're going to buy a 2-unit. We had to put 15% down on that. So $550 purchase price. The loan amount's $467,500 with that 15% down. And then you can see the interest rates change though. We're at 7.125 because we can't use 6.7 because it's not a single family residence, it's a duplex. And so unfortunately, conventional kind of hit you with that a little bit. Even though they reduced the MI, they increased the interest rate a little bit on you. But 2-unit, 550,000, you're paying 1925 your first year making payments. So that right there really helps you out. If you've got the cash, you got that 15% down, you're only paying
Sorry, I have to plug in.
Yeah, no problem. So you're only paying $19.25 on that first year on your mortgage payment. So that's not too bad, putting 15% down. Now, you're going to refi that in about 6 months to a year. I have 2-unit FHA refi. I made that mistake, and this is all conventional right here. So at 550 down with the refinance, so we're going from 7 1/8, which is 7.125, down to 6%. Your mortgage payment for that duplex now, that's including the rent, is only $1,579. So that is crazy. You're buying a $550,000 property for only $1,500 a month, and really only putting 15% down. So if you've got the cash, this makes a lot of sense. And I will tell you this, you're buying your first property on the FHA and on the conventional side, we can use gift funds to help you cover the difference.
I was going to ask that.
Yeah. And so that's a lot of people are like gift funds. It doesn't matter. You're a first time home buyer. You can use gift funds for a conventional and FHA. So that works pretty well. And then on the last column, is this the same as FHA? What if I move out of that property, start buying you can buy another triplex or duplex, or move into a single family? You have now covered your rent, and your net profit is about $820 a month. Buying a duplex right there. And that's probably after about 2 years, I would say.
Right.
So this is the tactic. This is the house hack right we need to see, because everyone's afraid of buying. The rates are high. Everyone's sitting on the sidelines. But if we can think outside the box a little bit, we can really help a lot of buyers right now maybe maximize their monthly payments.
No, I think this is a really great solution to that. And also you're, again, building wealth and building something for your family and your future.
Exactly. That also, when you build that wealth and you have that equity, you can tap in it for so many different things, and you could tap in, get a home equity line of credit and use that to buy more properties, use it to buy your forever home, whatever you want to do. And that's one of the biggest things that helps. Your tenant is helping you create equity by paying off the mortgage, and then just through appreciation, you're creating equity on that. And the best thing about this is a lot of people, and rightfully so, might be a little trepidatious, or they might be a little scared about having an investment property. It is. There's a lot of responsibility. I'm not gonna lie, but the nice thing about living in a unit is you kind of have hands-on experience on how to become a landlord without having it to be so far away, removed from the property. You have hands-on experience. You're living in there, and it really creates a lot of effort on your part, but it also creates a lot of knowledge on your part on how to become a landlord.
Even if you hired a property manager to take care of that other unit so that you would have a level of separation, there would still be enough in there to cover that.
Absolutely.
So maybe you are scared about it. Average property management costs are about 10%. So you're fine.
Is that 10% of the rent? What's the?
Yeah, typically about 10% of the monthly rent.
Okay. So, that's not too much if you wanted to have, someone there for a year and then help them, teach the ropes to you and get some stuff under your belt. And this is also good for, buying more investment properties, because there's different ways without having to, like you were talking about the DSCR loan, there's different ways to buy investment properties without having to use your income. But a lot of lenders want to see that you have experience being a landlord before they'll allow you to do those investment loans.
This is a great way to do it.
It is. I love it. It gets me excited. So that is about it.
Jeff.
Yes, you're welcome. So do you have any questions, or we?
I think we're all set.
Perfect. So I just wanted to say, hope you guys learned something right now, and don't be scared. Real estate right now is affordable, and the best thing is there's still some negotiations going on, so we might be able to help you offset some of the higher interest rates.
Thanks so much, Jeff. We'll talk to you later.
All right. Thanks, guys. Take care.